Hi everyone, and welcome to the first installment of Blue Chip Investing's YouTube channel. We are happy to have you, and before the video I would like to just ask you to please like our video and subscribe to our page. By subscribing to our page you will have access to all of our content as it becomes available. You will not have to check the page. All of the subscriptions will come directly to your email. It also helps us grow. I am going to be going over how I set up my most simple trades that I use most commonly. I'll be using the Thinkorswim platform through TD Ameritrade. If anybody does not use TD Ameritrade and is unhappy with their brokerage account, IRA account, please let me know. I'd be more than happy to help set you up with an Ameritrade account. Thinkorswim is a great tool for not only charting but access to content as it becomes available. It is probably the best tool that you can use in the markets. I absolutely love it. You should definitely check it out. But without going any further, I'm your host David Reinhardt, and let's go ahead and get into this. So even though that I did take some questions from Facebook, I felt that for our first post it would be most appropriate for me to show you guys basically how I set up most of my trades. I don't use this for every single trade that I make, but a majority of trades that you see me make on Facebook, on Twitter, or any other social media, most of them come from this same general idea. So in front of you, you see a graph of MRO, which is Marathon Oil. I've traded this a lot over the year. Really nice stock to trade. It's a great swing trade stock. Doesn't take up a ton of capital. Moves pretty well. Really love this stock. I don't necessarily view it as a long-term stock to just buy and hold. But I do think that the swing trade opportunities are great, and I really don't see it going anywhere. It's been around for forever. I really think that this is a solid stock. So basically, as we can see, MRO was trending upward. This chart is I believe it is a 9 months chart. So we're going back to last May. We see that MRO is in a pretty decent upward trend, but more so channeling between $11.50 and $16 for about 7 months. So you see here that you can continue to see different trading ranges as the stock moves. Now you'll see here, and I'm still trying to figure out how to draw these ovals. There we go. So you'll see here that on December the 12th, MRO hit its high of 1928, and since then we've watched Marathon Oil continue to trade in a downward trend. Downward trends are not fun. However, downward trends present the same opportunity as uptrends when it comes to capturing cash, especially on swing trades, because all that we're looking at is price trading ranges. So as the stock continued to drop, we really had no clear indication on what a new trading range was. So as it continues to fall, we see here that it starts playing around in this area that was from about $15.50 up into about $16.50, which is about a $1 move. So couldn't really get any sustained move at any point. MRO takes a little bit of a plunge, and then for the first time we see it hit $14.50, and at $14.50 the stock goes back up to $16.82 was the high for this day right here, and the low was down here at $14.28. So we are establishing that we are starting to see a new trading range. The stock has been trading in this oval, which goes from March the 5th until April the 8th. Those were all the days that the stocks fell within that price. So we definitely see a new price trading range currently. And after it got up to 1650, 1670, we see that it dropped back down. So we're starting to see MRO approach its new trading range that we currently see it in. Feel a little bit more comfortable trading the stock now that it's a little bit off of its 52-week high. When it was getting up in the $17, $18 range, I was having a hard time buying it because the risk outweighs the reward, and it's really just not worth it to us. Now at $14.50, I feel very comfortable owning MRO. It has a great support level at $14, so $14.50 is a great initial investment in my opinion. So I went ahead, and this is how I set up most of my trades. I wanted to make sure that I didn't miss any upward move of MRO to the $15.50 level. I'm looking to sell MRO right around this point. $15.50 would give me almost a $1 move on my shares. So I wanted to make sure that I wasn't going to miss out on that. So what I did was I just went ahead and I bought 500 shares. I'm going to go ahead and act like I'm setting up this trade today, even though I actually executed this trade about 2 days ago. So we're going to go ahead and say that I bought those 500 shares today. What I would do is I would write a covered call for May 12th, and I would set that covered call at $15.50 because that is where I'm looking to get out at anyway. Now, for those of you who don't understand covered calls simplified, and we will have a segment on this. Covered calls are basically a way that you give shares to somebody and say, you can have my shares at $15.50 if this stock goes above it. So as long I make everything up until $15.50, and I plan on selling at $15.50 anyway. I really don't think that MRO is going to hit $15.50 within the next 10 days, but it is possible. However, I will collect a 10-cent premium per every covered call that I write. So I write 5 covered calls. That's equivalent to my 500 shares that I've already bought at $14.65. So those 500 shares will now be sold out at $15.50 if the stock is able to hit above $15.50. If not, at the end of May 12th, I keep my $50 premium, I keep my shares, and that's that. That trade would be completely wiped out. So I plan on selling at $15.50 anyway, so why not go ahead and take a $50 profit for doing exactly what I was going to do? You need to plan out your trades before you make them. If you don't plan out your trades before you make them, that's when emotion comes in. And when you let emotion into trading, it's not a good thing. You will almost always lose if you let emotion run your trading. You need to have a clear-cut plan before you go into any trade. And so my plan here is that at $15.50, I'm going to sell this stock. And at $14, I'm going to watch for a bounce. And if I see a clear trend reversal, I will dollar cost average half of my position, so another 250 shares, and I'll write covered calls again. Now, with my other 500 shares that I would normally buy, typically I like buying 1,000 shares of MRO, but since it wasn't quite at $14.50, I went ahead and I wrote 5 cash secured puts. We will also be going over 5 cash secured puts as well. But what a cash secured put does for you is it allows you to write a put at a certain price with a certain expiration date and collect a premium for doing so. Your goal would be obviously for the stock to not hit that price so you collect the premium and you don't have to put up any money. Please understand this before I go into this. You cannot write cash secured puts if you don't have the cash to buy the shares. And what I mean by that is, since I'm writing 5 contracts at $14.50, that means that I need to make sure that I have $7,250 to back up in my capital in case this stock breaks $14.50. Because if it breaks $14.50 and stays below there after May 12th, I am obligated to either take the loss or buy the shares. So I will obviously buy the shares. And the reason that I like this method is because I'm going to buy shares at $14.50 regardless. I am not going to sit around and not buy shares at $14.50. So I'm going to get a $30 premium for every contract that I write at $14.50 for Marathon Oil. So when I write my 5 contracts, I'm given a premium of $150 to basically tell someone that I'm willing to take shares at $14.50 through May 12th. If the stock finishes above $14.50, I'll keep my $150. The option expires. I keep everything. Nothing changes. I just keep my $150 premium. If the stock ends up dropping below $14.50, I'll still keep my premium, but I'll also own 500 shares at $14.50. Even if the stock's at $14, I was obligated to buy those shares at $14.50. Now, some people don't like this because they don't like having their hands tied. But I argue that if you're going to buy shares at $14.50 anyway, if you're going to sell them at $15.50 anyway, why not get paid just to execute your plan? It's simple. And the great foundation behind this is that I do not believe that this stock is going to go much lower than $14.50. I'll take my 1,000 shares at $14.50 if it drops below that. If not, I'll keep the money. However, let's also take this into consideration. If MRO does finish below $14.50 after May 12th, I will also have collected my $200 worth of premium from covered calls and from my cash secured puts, which means that my true dollar cost average on 1,000 shares is $14.30 before I even start the trade. So as long as Marathon Oil is above $14.30, I'm already ahead. So the stock could finish at $14.45. I could have to take the shares. My covered calls would expire worthless, but I would still end up having dollar cost average my position down to where I'm already ahead on the trade. So I look for trading patterns such as this to where I can get in at a good price that I'm comfortable with and still be able to execute my trades with options that give me premium. Anytime I'm able to get free money, I like doing that. If I can get free money from dividends, options, and premiums, I'll do it anytime that I can. So let's go ahead and set up another trade that I did with Under Armour prior to its earnings. So Under Armour has had a very, very ugly year. I'm still a big believer in it. It's a mid-cap. It has serious growth. They've hit a small snag similar to what Nike ran into when they were first growing. I still think it's a great company. I still own long-term shares. I'm still dollar cost averaging my way out of the last drop that it had from the earnings 1 quarter prior to this. But I'm going to go ahead and I'm going to show you a trade that I set up with Under Armour. So I had bought shares previously at $29, which did not work. However, I knew the earnings were coming up, and Under Armour had performed poorly already up until this point. So I was able to back my position, hedging it with puts. I bought puts a few dollars below where the stock was currently trading at, and I bought just enough puts to where if the stock were to have a large drop, such as how it actually did, I would still make money on the stock going the other direction. And that's what ended up happening. So Under Armour drops from 28 and it comes all the way down to 20 and it gets down to 18.50. So I've been looking for a spot to dollar cost average Under Armour, but I was concerned because I tell people all the time, when a stock starts dropping, your first thought is, I need to buy shares right now because this stock is cheap. But you need to get away from that thinking, because I use the reference of, if a knife were falling, would you try to catch the knife, or would you let the knife hit the ground first and then pick it up? And so that's what I did with Under Armour. I watched the trading pattern, I watched what it was doing, and then it hit that low of 1840 and it sort of stabilized a little bit. So as we were run up into the next earnings, which was in this area right here, I told myself, oh, I need a dollar cost average at some point. So what I did was I went ahead and I wrote 1850 cash secured puts, and I collected a premium of $200 for writing those. I didn't buy any shares, and I did not do anything else with the stock other than that. I still own my initial investment from 29, and then also my long-term shares that I've been accumulating in the stock for quite a while now. So the stock doesn't hit 1850. We get a pop of 10% on earnings, and the stock never comes close to 1850. I'm able to collect a $200 premium just because I was willing to take shares at 1850, which was a 52-week low, and I'm able to collect $200 just for saying that I was willing to buy those shares at that price. So writing cash secured puts are a great way of trading. It's a great way to dollar cost average. It's a great way to get yourself out of a bad trade. It's also a great way to make sure that you are continuing to execute your plan. Like I've said, if you come into a trade with no plan, you're probably going to come into a trade with no money, because emotion will set in. It doesn't matter how hard you work on it, emotion will set in. Greed will set in. Fear will set in. Uncertainty will set in. There's all these emotions that can run our trading, but by using cash secured puts, covered calls, you can't lose. You've already executed exactly what you want to do with the trade, and you have yourself protected. Now, if you want to hedge your trade, you can also buy puts. We'll go over that in another segment as well. But by writing cash secured puts and writing covered calls, we can be on both sides of the stock so that we are constantly making money. And remember, if you are going to end up having to buy the shares on the cash secured puts, you can also remember that means that you're going to be collecting the premium from the covered calls and holding on to your shares. So then your new shares that you get from your cash secured puts, you write covered calls once again, and then you write more cash secured puts. You're constantly dollar cost averaging. You're constantly making money on premiums, and you're constantly helping yourself get out of bad trades, capitalize on bet good trades, and it is just a no loss formula. But we do need to remember a few things about this method. One, and most importantly, you need to do this with stocks that you are comfortable with. If you're not comfortable holding this stock for over a year and waiting for this stock to come back, then this is not the right stock to use this method with. We also need to remember that when we're buying shares, writing cash secured puts, writing covered calls, we can sort of lose focus on our capital. We need to be conserving our capital. At no point should you be more than 50% invested in anything. 50% investments for all your investments is all that you should have wrapped up. Because if we run into a recession, if we run into a strong downtrend in the market, you are going to rely on that capital. That capital is going to be what saves you, and that capital is going to be what gets you out of bad trades, no matter how bad they may seem. I've been in trades where I've been down 25%, and while it's no fun, you also do gain experience by seeing how much capital means to you. You do not need to go in on a trade and throw all of your money into one certain stock or multiple investments. It is a surefire way to get burnt, and you will not be successful because you cannot sustain growth from that. Because you will run into a stock where one day you wake up and the stock is down double-digit percents, and you are going to need to figure a way to get through it. So when you're using this method, I please ask you to use blue chip stocks that have been around for a long time. Use stocks that you are comfortable trading and comfortable holding on to, and also price ranges that you are comfortable holding a stock at as well. I never think that it's a good idea to continue buying a stock that's pushing up against its 52-week low, because there's more risk than there is reward. I'll give you an example. Everyone knows that I love CenturyLink, and I'm going to pull up the chart on CenturyLink. And I'm going to remove my old drawings. But I bought CenturyLink right before the dividend, and I also bought CenturyLink down around the low. So in these two positions. So I love this stock. I was in at a pretty good price. I was comfortable with it. It got a really nice run right here. And that run took us all the way up to 26. But if we look, and we want to take this section out. Let's go ahead and take this section out. We're looking, and right here at $26 has been a hard spot for this thing to crack. It hasn't been above it since November 1st of 2016. So at this point, you say to yourself, I have a nice profit. I've collected a dividend. I've been collecting my cash secured put premiums. I've been collecting my covered calls. What do I want to do here? When the stock's trading at 26, I say, well, at this point, there's more risk in this stock than what there is reward. It's bumping up against a 3-month high. It's going to take a little while for this stock to break through 26. If it can break through 26 and hold, then we're talking about something completely different in a stock that could potentially go to $28, $29, $30 within a month's span. But we haven't seen that move yet. So the smart move here is to go ahead, take your money, cash it out, and we come back to the trade that I just showed you guys with MRO. I take that money away from CenturyLink and I just reinvest it right back into MRO, because there's more of a reward here than there is a risk with Marathon Oil, because we're at a low, we're at a position where the stock is in a good trading range. So we like this stock where it's at. So we take our capital out of CenturyLink, take our money and we go ahead and reinvest it here in Marathon Oil for the extra reward. So I hope that this has been informational. I hope that this has helped you. I will be doing segments shortly on how we write covered calls and exactly what they are, and how we write cash secured puts and exactly what they are. If you have any questions at all, please feel free to reach out to me. You can comment below, or if you're on our Facebook page, feel free to send me a message or tag me in a post on Blue Chip Investing's Facebook page or group, and I am more than happy to answer any of those questions. I hope that you all have a great night, and I look forward to helping you guys with any further questions throughout this week. Hope you all have a great day in trading, and we will talk to you later.